Fiona Yang, who's the co-manager of Invesco Asia. So we'll be talking to her in a minute, but first we've got a couple of news things to have a look at. So two things that happened this week. One is that Axiom European decided that it was probably not going to continue. And the other one is Bluefield Solar was announced that he had been awarded some contracts under the new government subsidy regime. I'll explain how that works. So Axiom first. It's been around since November 2015. It didn't raise as much money as it wanted, but the idea of it was quite complex, and I think that was part of the problem, that people didn't really understand what it was trying to do. But in a nutshell, after the financial crisis, 2008-9, the regulators really realised they had to do something to make banks and insurance companies' balance sheets stronger. So they introduced some regulations designed to achieve that, Basel III and Solvency II. So Basel III for the banks, Solvency II for the insurance companies. And there was an opportunity for Axiom to buy the old debt that wasn't going to be kept post this reorganisation, profit as that was retired, and then roll into the new stuff. So it was a one-off opportunity, but I think they've come to the conclusion that we've been more or less there, done. The fees were reasonable, I thought, especially that the manager agreed to cap them at 1.5% of NAV, and that was good news. But there was a performance fee, and I didn't really like the way it was designed. So in theory, the fund was targeting returns of 10% a year, but the performance fee was 15% of all the returns, over, provided that you hit a 7% hurdle. That's sort of compound from the beginning. But it just seemed that if you're targeting 10 and your hurdle is 7, then you're sort of saying, well, more or less guaranteed to earn performance every year, and we're just going to take 15% of whatever you take. In practice, things haven't worked out perfectly that way. There is the chart from our website of it from the beginning. And as you can see here, the discount has been slowly, steadily widening until we get to the very last moment when they make this announcement. NAV tracks sideways, really all the returns are becoming form of dividends. That's not that unusual for a debt fund. Here it is against its sector, so which is debt, loans and bonds. So within this peer group, it's not very big. In fact, actually, that's probably really the problem. This is really only one fund, and combined, it would still be a bit smaller than Axiom, but it is slowly winding itself up. This is part of another fund. So really, you could argue that of this sort of ongoing peer group here, it's the smallest one. Discount-wise, 7% is not enormous, but this is post the announcement. Before the announcement, it would have been, well, it's definitely even more towards the bottom end of the sector. The yield is fairly chunky. As I say, that's been providing most of the return so far, and ongoing charges, as I said, that's excluding the performance fee. Still on the sort of medium size. There's its returns, not great this year in terms of NAV, but actually over the 3-year, 5-year numbers, it comes top of this peer group. That's not particularly impressive when you look at it across the whole lot. Obviously, all these funds have been fighting a big headwind in the form of very low bond yields, and now inflation, meaning that rates are going up, meaning that those bond yields are now starting to rise, and that's bringing down the capital values of the bond portfolios. So that's making life quite difficult for all of these funds, and that's really why they've all struggled to do particularly well. But against that, Axiom has done a reasonably good job, as you can see there. And there are the numbers on a monthly basis, going all the way back to the end of 2021, this is. So we were targeting 10% a year, so we didn't make that in the first year, kind of made up for it in 2016, fell back again in 2018, made up for it again in 2019, fell back in 2020, made up for it in 2021. You can see this kind of cyclical thing going on here. And actually, it turns out that the performance fees they've earned haven't been that big, because this sort of 7% hurdle thing has sort of come and gone in terms of whether they've been passing or not. Anyway, so we get to the situation now. Realistically, the opportunity that they were set up to create has gone away. The discount widening is not helpful. There's not much liquidity in the shares because it's so small. Some of the shareholders, when consulted, said we want out. So what they've decided to offer is a choice of cash at NAV less costs, or roll over into an open-ended fund managed by Axiom. They do have a couple that they can choose from, and we're not quite sure which one it's going to be. That's going to come out down the line. Basically, we're not going to see proposals on what's going to happen here until early 2023, but then the transaction will be done pretty soon after that. And I think if you're looking at this, that sort of 7% discount therefore will close between now and maybe like sort of February 2023. So that provides you some upside, and you will be earning some yield on the way through. So I think it could be an interesting-ish investment, but only in terms of like maybe breaking even in real terms, given some inflation. So there we are. That's Axiom European. Bluefield Solar. It announced this week that it got awarded some contracts under the new subsidy auction, allocation round 4, AR4. And these, as I'll explain in a second, are in the form of contracts for difference. So Bluefield got some of these, from Next Energy also got some of these as well. In Bluefield's case, it covers 3 of their farms, solar farms, including one biggish one, Yelvertoft, that was originally planned to be a subsidy-free plant, but since they could apply for subsidies, why not go for it? The way that it works, basically, the government said we will support the development of 2.2 gigawatts of solar in this particular auction round. These things are supposed to happen every year. And then people bid at the subsidy level that they're prepared to take, or the CFD level they're prepared to bid in. And that cleared at £45.99. That's all in September 2012 prices, because these are never straightforward. So that's equivalent to a price today of about £57.82 a megawatt. And that grows over time in line with inflation as measured by CPI. So the CFD contracts last for 15 years. So that should give you enough time to get back the money you spent investing in building the plant in the first place, and some more. And they kick in from March 2025, so not straight away, but then these things aren't built yet. They are in the process of being constructed. And it's a guaranteed price for the power that you produce. So basically, if the market rate of power, the price you're selling your power for, is below the CFD strike price, then you get topped up. But if it's above, then you have to pay the excess back into the system. So what they've done is given themselves peace of mind, really. If you look at it relative to where power prices are, it looks incredibly cheap. So there's £57.82 now, and the current power price is all the way up here. Because we know that's because gas prices have gone mad, and gas is the marginal producer of power in the UK, and it's the one that sets the power prices. But basically, the government's signing up to get solar at prices down here. So you can see the attraction of doing that. And solar is one of the cheapest forms of power generation that we've got, despite the fact that we've got grey days every now and then, and it doesn't generate the night. So it makes absolute sense for the government to be doing this, because it's going to help drag prices down to those sort of levels. I mean, at the same time, they auctioned a lot of wind capacity off, and that struck at even lower levels than this. So yeah, the prices are still going to be trending down, which is obviously good news for us as consumers. Yeah, I think that sort of covers what I wanted to say on that, really. We did say, we wrote a news item about Next Energy Solar when this happened for them. Just to say, I've corrected it this morning, but we thought then that the price is linked to RPI rather than CPI, and that gives you a much higher number. So I've corrected the news article for that. Good. All right. So that's it from me. As I said,